Hello and welcome to The Money Show, your one-stop destination for all personal finance queries. I am Snehisha. You're watching ET Now. We have a power-packed show lined up for you on the first day of 2025. Joining us in the first segment is Mr. Harshvardhan Roongta to talk about how you can make the best of your personal finance planning in the new year. And in the second segment, we will throw open the counter to get your mutual fund portfolio queries answered. So do send us your queries on our WhatsApp number 865-797-4571. Or viewers, remember, you can also email us your queries on themoneyshow@etnow.tv. But on that note, let's kickstart the show then and discuss what 2025 could shape up to be like for your personal finance portfolios as we approach the new year. Many of us are thinking about how to navigate the economic shifts, manage our finances effectively, and also tackle the economic uncertainty that we're seeing. To discuss all of this, we have Harshvardhan Roongta, CFP of Roongta Securities, joining us on the show to talk about how you should go about planning your personal finance in 2025. Mr. Roongta, great to connect with you and thank you so much for joining us. First of all, wishing you a very happy new year and welcome to the show. Now, some of the top things that one should be taking stock of early in the next year, could you highlight what some of these most important factors would be on your to-do list to tackle as soon as the new year begins?
Well, it's the beginning of the year, so most certainly many people will be making resolutions. So if I may just rephrase the to-do list to say probably resolve to do for your financial well-being, well, there are a couple of them that I have noted down. The first one is that every individual should basically resolve to rather put all their investments or investments or expenses into insurances under the auto mode, which simply means that if there is minimum intervention wherein you have to take the effort of making an SIP or transferring money into the fund house, etc., it tends to get a little slack. So if you would attempt to put all your investments towards your mutual funds or insurance premiums towards auto mode, that will only ensure efficiency in timely payments. The other one would be that you would be disciplined with your investments and you would not try and time the market. So that's another very, very basic essence of good investment and good financial planning is that you'll be disciplined with your investments and not try to time the market, because invariably most of the mistakes are done when you're trying to outsmart the market and time the market. The third one is that you focus on asset allocation and not chase returns. Now, what I mean by this is, if you look at what happened in the last 2 years, we've seen many investors, deviating from their asset allocation plans and trying to invest into asset classes which are generating higher returns. Now, that doesn't seem to be the good idea for 2025. So my suggestion would be that investors stick to asset allocation plan rather than chasing returns. The fourth one that I would say is that you please have a detailed look at your health insurances, your life insurances, your disability insurances that you have. Review them and increase them if there is a requirement to do so. If you haven't purchased anything yet, I mean, it's high time that you look at risk coverage for the financial well-being of your family, because in case of any one event, there could be a huge financial hole on your financial plan. Um, one suggestion that I would like to give everybody would be quite contrary to your relatives and your relationship that you want to keep in this year. Simple suggestion would be that resolve that you will not oblige your friends and relatives by buying insurance policies which are investment oriented, just to help them fulfill their yearly targets. Or for that matter, do not even oblige any of your bank managers or anybody influencing you to buy something only because they have targets to meet. I think you have to take care of your own finances. You work very hard for it, and it's high time that you take good care and be very diligent with how you spend your money. The last one would be more on the spending side. I mean, we've seen people making unnecessary expenses just to show off on social media and Instagram. But I think you should be a little more prudent with your money. Be wise in spending. We're not saying do not spend money, do not use your money for your well-being, for your happiness, but just be a little mindful. Are you spending it only to show off on Instagram? Well, if that is the case, then it's about time that you start taking your money seriously and your hard work.
Well, yes, you did highlight that you need to periodically review your portfolio. Could you tell us what this frequency should be like and how often does one need to sit down and review their entire portfolio and their savings, investments, as well as stock holdings?
So, but there are two occasions on which you would want to review your portfolio. So, one is, of course, it's time bound. So, the moment you make a portfolio, you make a plan for yourself, you say to, you ask yourself, do I want to look at it again after 6 months or 1 year or 2 years? So that is essentially the time frame that people would look at, depending on how your portfolio is constructed. So either every 6 months, every 1 year, or 2 years. So once in these three time frames, you would set yourself a target to have a look at it again. The other element on which, or the occasion on which you would look at your portfolio or review it would be if there is any life-changing events that are happening in your life. Say, for example, you got married, or you have a child now, or you lost your job, or you've switched your job, switched your cities. So, if there is any such event that has prompted a change in certain finances, then you would go back and look at it. So, there are two occasions, as I said. One is a fixed time period, which is 6 months, 1 year, or 2 years, or the other is on an happening of an event which requires to relook at your finances.
Well, Mr. Roongta, I came across a very interesting Bank Bazaar report, and we were also chatting with the author of the report recently. And this is on the health insurance front, overall insurance front. The health coverage has improved marginally in the year that went by, but a drop was seen in life coverage. The percent of people who had neither coverage, health or life, has nearly doubled. Help our viewers understand the importance of being adequately covered by life or health insurance.
So, well, insurance, in fact, is the first step of financial planning. So, imagine a situation that you're in the process of accumulating wealth for yourself. You walk down that path for, say, about a couple of years. So, God has been kind, nothing has happened to you for, say, 5 years or 10 years down the line. And suddenly there is a medical emergency and for which you need to be hospitalized. There is a great chance that the corpus that you've accumulated over the last 5 to 10 years will get exhausted in just one hospitalization that you may require. So all your hard work of wealth creation for 5 years or 10 years will go out in just one hospitalization. On the other hand, imagine a family which has, say, one person, working and all others are dependent, or you have a double income family where two people are working and the family is dependent on their income. Now, what happens in a situation if that earning member of the family meets with a mishap and it passes away? What happens to the income of that family? It either stops completely or there is a loss of income if there are two people earning. Now, how does the family take care of their finances in case the earning member of the family is not there? How do children pay for their school fees? How do you get ration for your house? So there are a lot of things that you need to be keeping in mind that if there is an income generating person in the family, or if there is an event that is likely to happen, such as it could happen that medical emergencies could come out at any point in time. Now, all these events lead to high financial loss. Either it could be in terms of medical expenses, or it could be death of the earning member. Insurance basically protects the family financially from all these events. So if you buy a good health cover, a good mediclaim cover for your entire family, including newborn children, then if anything was to happen in terms of health emergencies, the mediclaim takes care of that expense and you don't have to dip into your financial savings, which can be used for future goals such as children's education, retirement, house purchase, whatever that may be. Similarly, if you don't have life insurance, I mean, if an earning member of the family is not there, what happens to the expenses that they have to incur? So you buy a life insurance so that in case you're not there, all the expenses of the family continue to be provided for, and they do not have to basically look out for other options and spread their hands in front of their relatives and etc. Now, the third thing that you need to take care of is disability insurance as well. In case of any eventuality which leads to the disability of an earning member, then there is a loss of income in that situation as well. So there are specific disability insurance covers which provide for replacement, or they provide you a fixed lump sum money in case of any disability, so that the person, while he's alive, he or she is alive, can use that money for their expenses.
Okay, thanks for that. And what are some practical budgeting tips for managing finances amid rising costs and inflation? We've seen inflation being rather sticky, especially when it comes to food inflation. So what are some tricks and tips that you would share with our viewers to be able to manage their budgeting properly?
So, well, Snehi, actually, budgeting is a very important exercise, and that can be done when you break your expenses into three parts. Okay, so one is fixed expenses. So there are certain expenses which you cannot do anything about. So those fall into the fixed expense category. The other fall into discretionary but variable. Okay, so it means that there are certain kind of expenses that you need to incur, and they are variable in nature. So they are more like wants. Like you may want to go out dining, you may want to go out for movies, etc. So that falls under the discretionary and variable. The third category is that there are certain expenses which have to be incurred, but they can be controlled in terms of how you use them. Say, for example, you would have some, expenses such as telephone bills. You could certainly control them. You could control certain outings that you have to do. You may want to go out, but at least you can cut down on the quality of the restaurants that you go or the kind of movies that you go for. So break your expenses into three parts. One, as I said, there's nothing you can do about. That needs to be addressed and looked at first. It needs to be allocated for. Now, these are your food, clothing, shelter requirements. You cannot do anything about them. The second, as I said, would be something that you can control. They need to be spent, but you can control. So there has to be some budget allocated towards that, wherein you can do something about it. So in case you're running out of budget in the month, ensure that you cut down on these. The third element was absolute discretionary, so which is now completely on your want side, when you believe that I want to buy an iPhone, you want to do a lot of other things. Now, if you're not left with that kind of money, then you have to cut down on that certainly. So if you plan it and put it into three baskets, and at the beginning of the month, you set aside money. So you put some money aside, say we call it an envelope budgeting. You set aside and put some money into that envelope and say that this is only for my mandatory expenses. This is only for my expenses, which is which is like kind of something that I can control. And the third is absolute discretionary. So then you don't have to, if you're not left with anything, you don't put anything into that basket. So this way you'll be able to control and monitor your expenses and cut down on those expenses in case you tend to go out of budget. Most importantly, if you're used to using your credit cards, because everything is online these days and invariably you'll be using your credit cards, one very effective manner to manage your expenses on the credit card side is, though you may use your credit card to spend money instantly, so you may just buy something through a credit card, make sure equivalent amount you put it in cash in another account or you put it in an envelope and keep it aside, so that as and when your bill comes for the credit card, you can settle it out of that envelope. So it's not that spend today and worry tomorrow. You're spending today and putting an equivalent amount of money available with you. So it's taking it out of the monthly budget, putting it aside. You have it ready when the bill comes, and you can pay that credit card bill. So these are a few tactics that you could possibly use to control your monthly expenses, be within the budget, and actually know what is happening with your money.
Well, on that note, viewers, time for a short break on this edition of The Money Show. We'll come back, and on the other side of the break, we'll throw open the floor to all your mutual fund specific queries. So you keep writing to us, and we'll be right back.